Nvidia went past 4 trillion about 2 weeks ago, right? It crossed over 8% of the S&P 500. One stock was 8% of the weighting of the 500 stock index, right? That's happened twice in history.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, we've got a new guest joining us in the second segment today, so I'll just touch on it quickly now, but this is really exciting. We're going to be partnering with Teammates. DeMoine Adams, the CEO of Teammates, is going to join us for some events to promote recruiting of mentors. There's a tremendous need. Just give us a quick thumbnail, prime the pump for the second segment.
Oh, I'm
David.
really excited to have DeMoine join us. We signed we've been partnering, and financially we've been supporting Teammates every year, but this year we stepped up. We're now the primary sponsor of their golf tournament annually. They're a great organization, and the need is real. They're lacking about 1,100 mentors needed right now just between Omaha and Lincoln. So we said, well, how can we help? And he said, spread the word. So, hey, we're having them on, and we're going to host not one, but two recruiting events on how simple it is to be a mentor. And folks, you want to pay attention to this because it's a great way to give back to the community, and it's less than an hour a week of your time, and you really can make a massive difference in a young man or woman's life. So anyway, I'm really excited for the segment.
Stay tuned for more details and to get DeMoine's story of how he ended up at Nebraska as a black shirt, and then how he ended up getting involved in Teammates. That's coming up in the second segment. But in the meantime, David, as always, a lot of news to get to. Now, I don't have a story to put in front of you, but as we sit down to record this show in the middle of the week, there's news all over the place about Treasury Secretary Scott Bessent calling on the Federal Reserve to do an internal audit, an internal investigation. He's saying you're exceeding your mandate, mission creep, they sometimes call it in politics or in the military. But what I haven't heard or seen is what is or are the specific concerns. Where does Bessent think the Federal Reserve has gone too far?
Well, they are doing climate studies. What does that have to do with their mandate? They were mandated and brought in for one purpose, and that was to simply manage our currency using monetary policy to help us stimulate growth when we need it or curb growth when the economy would get overheated, to keep us from having crashes, etc. So then we added, many, many decades later, a second mandate of full employment. So they have what we call a dual mandate. Basically, when unemployment's below 4%, that's considered full employment in American society. So we're pretty close to that now, 4.1, 4.2. And then they move interest rates. Now, they have changed the language on how they slow down the spigot. In other words, if they make interest rates cheaper, capital's looser, easier to get, which means it's easier to expand the economy. Businesses like ours can invest capital faster. We can get access to cash to expand if we want to, right? Businesses can invest, so you grow the economy. They raise interest rates to slow that down. Now, a secondary factor is inflation will come if growth gets too hot or if there's too much money in the system for the amount of products that are being produced. And so therefore they've massaged their language saying, oh, we control inflation with interest rates, which is nonsense, right? Inflation is controlled by one thing, M2, money supply. We talk about it over and over. In fact, I sent a chart to you when you asked me to talk about this briefly. And this is from the Federal Reserve. This is their chart. Now, Brian Westbury, the economist, a famed economist of First Trust, who we quote often here, this is his handwriting on the chart. And he was the one that put this out on X or Twitter. And look, if the Fed can control interest rates when interest rates are low, we would basically have inflation. If you lower interest rates according to them and you hold them down artificially low, then inflation takes off. Well, as you can see on the chart, we went about 7-8 years with 0% interest rates, basically. There's no inflation. We had zero interest rates again after COVID hit, and we had massive inflation. What is the difference? Well, they printed money, right? It's money supply.
Okay.
So what Scott Bessent is complaining about is they're trying to manipulate the public with this idea that they're mandating inflation when that is not what they're supposed to do. They're supposed to help the economy grow, which means making interest rates easier, money looser when you want to accelerate growth. Well, we are not growing in leaps and bounds, but unemployment is down. Therefore, by their mandate, they should be lowering interest rates, right? And
so you're saying these interest rate decisions have been more shall we say, political rather than
100%.
economic.
And this has gone on now for a couple of decades. This is not new to Powell. This was Yellen before him and Greenspan and Bernanke. It doesn't matter. They've all been very political the last 20 or 30 years with the Fed. The reality is they can't control the economy. They control short-term interest rates, which does have some ancillary effects on the economy. But if they are data dependent, which they keep saying in speeches, well, then you would lower interest rates based on the data and based on what you did by precedent last September, cutting 50 basis points when inflation was 45% higher than it is today. Anyway, so on top of that mission creep, we have over 650 employees at the Fed. What for? What do they do? And here's the thing that I want to ask. How are they paying the bills? How are they keeping the lights on there, Chip? They used to run what's called a scarcity model. They would keep around $700 billion in capital reserves, 507, and banks would come, deposit overnight to shore up their balance sheets. They had to do every night. It was just a window. And the banks would pay the Fed interest. They flipped the script about 15 years ago and now do this abundance model. And now we pay the banks interest to deposit money at the Fed, and we're sitting with a $7 trillion plus balance sheet. We're losing $100 billion a year the Fed is losing. Where are they getting the money to pay their bills? How are they paying those salaries?
It's
now you're
not,
getting me started on a rant here.
How do you really feel? It's not, strictly speaking, a federal government agency, but maybe there's some way that we could sick Doge
their
on
website
the
is
Fed.
GOV. Their emails are all government emails.
Oh, is that right?
So, there's some debate on this. And another economist that we do, a macroeconomist.
I think there's a pretext there. We could send Doge
Danielle
after him.
Martino Booth. We
We've
quote her often
before,
as well. She says the Fed are really actually our government employees.
Yeah.
And she actually worked for the Fed, just so you know. That was her previous career.
Well, let's get Doge after him.
Yeah, exactly that. And so I think the American public absolutely wants the Fed audited and stream back down. Now, they can serve a purpose, but, anyway, we can get into a whole conspiracy theory on global banks around the world, the Rothschilds, et cetera. But yeah, it's definitely something that needs to be looked into and quick. And so Bessent is selling the right message, I believe.
All right, let's shift gears to the markets, David. The S&P roaring and soaring. And you sent the team a chart showing that Nvidia has now hit market cap territory that hasn't been reached since, am I reading this right? IBM back in 1969 as far as dominance of the S&P?
Yeah, so Nvidia went past $4 trillion about 2 weeks ago, right? $4 trillion in market cap. And so, you know me, I get up at 4 a.m. and start doing some data hounding, and I have access to a lot of data. And so I went back in the archives here, and I was like, it crossed over 8% of the S&P 500. One stock was 8% of the weighting of the 500 stock index, right? That's happened twice in history. And exactly, you got to go all the way back to 1969. Chip, I was one. I was 1 year old baby. And AT&T, right? Ma Bell was 8% of the market. And then you got to go all the way back prior to that to 1949 when the other case, right, that happened. And in both cases, the federal government sued those companies to break them up. IBM one and AT&T was the other, right? The two examples. They were successful in breaking up AT&T, the Ma Bell breakup, but that didn't happen for almost 20 years. 1984, I believe, was the breakup, right?
Yeah.
They sued IBM. They lost that case, but it took 27 years to put that court case to rest.
I think AT&T was the one back in 49 and finally accomplished in 84 the breakup. IBM, as you say, never was. Well, in your chart shows how IBM dominated in the 70s and the 80s.
Yeah, and they were the early winners, obviously, in the computer age, et cetera, right? But the point being is stocks can't stay up in this lofty territory forever. Again, NVIDIA's a great company. We have a lot of clients that own this and portfolios, et cetera. I'm just saying this is definitely a word of caution when something gets this far out over its skis, so to speak, is a phrase I sometimes use, cautionary tale, it could pull back severely pretty quickly.
The president says, well, here's the Fox Business headline. Trump absolutely going to renegotiate USMCA. That's United States, Mexico, Canada. That was the big trade deal he did during his first term as president. I thought the USMCA was a Trump success, but apparently he thinks it needs an update, an upgrade.
And this is where I get upset with Trump, right? And because people know I voted for him, I talked about it, but listen, you got to lay out the playing field for business owners to understand what's the rules of the game. I have no problem if you're going to put tariffs on any country. but you can't keep doing this flip flop or taco, right? Trump always chickens out. And as we came in the studio this morning, Bessent actually announced, well, the August 1st deadline for China, no, that's August 12th now. So they just chickened out once again,
okay.
right? And there's another acronym going out there, FAFO, and we're not going to say what that means on the air, but
fool
that's
around and find out.
Fool around and find out. There we go. Fool around and find out.
Yeah.
But if
Gotta
that
keep
were the case, if
happy.
they hold the line, we'll see. But I don't care if there's tariffs or not. Take the tariff revenue and replace it with, take away income tax that you're charging the lowest income people in our country. That was the deal that he campaigned on. And I don't think anybody have a problem with it. But the problem is the media doesn't report anything accurately. And he does. He's flip-flopping a little bit here too much. Do it behind the scenes in the boardroom. Flip-flop all you want, but put a unified message out so that CEOs need to understand how much they can spend, what they want to borrow, if they want to expand, if they want to cut jobs. But right now, most CEOs surveyed are a little nervous, Chip.
Up next, Retire Smart is a major sponsor of the Teammates Mentoring Program. The CEO of Teammates joins us next to talk about the need for mentors. You're listening to Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Retire Smart is a major sponsor of the Teammates Mentoring Program. That includes partnering with Teammates to recruit mentors. We have a special guest with us to visit about 2 upcoming mentor recruiting events. David, please welcome the Chief Executive Officer of Teammates, DeMoine Adams.
Yes, thank you, Chip. In the studio joining me, really excited, we have DeMoine Adams, the CEO now of Teammates. Well, you've been the CEO for a couple of years now, right?
It'll be 4 next month.
All right, congratulations. You and I have become sort of friends here over the last 2 months or so, and had conversations. I've had to learn how to grow and be a CEO versus my previous role, which was really just the advisor in front of clients. And you have gone through that same transformation. You've been with Teammates for quite some time now, and then you've kind of taken the reins and had to learn how to be the head guy, right?
Yes. Well, experience is the best teacher, even if you can learn it from someone else. So I've been very fortunate to receive that mentorship from co-founder Tom Osborne.
Yeah, I was going to say, you had a pretty good coach in there, and Coach Tom Osborne, obviously a legend who started Teammates, probably in the early 90s, is that right?
1991. We just celebrated 34 years here in April.
That's awesome.
And the sustainability of the organization, we have an incredible team. Coach Osborne, he's still heavily involved. He's a mentor to 2 kiddos to this day. And he's not slowing down, nor his teammates.
Well, I love his character. We were talking before we went on air just briefly about the recruiting experience when he recruited you out of Arkansas, out of high school, and they had just won the national title. And you're saying, yeah, they still flew in, even though he was going to be exiting out a year later, and gave you the full treatment. And obviously that mentorship has meant a lot because they pulled you into the fold for the organization they started.
Absolutely, and it says a lot about his leadership. He's a man of his word, his integrity, his character. I went to their summer football camp before my senior year. I put myself on their radar. I was a 2-star, maybe 2.5-star football player. But after that football camp, Coach told me to do 2 things: have a good senior year and get my ACT score up. I did those 2 things, and I got that phone call in November. Of course, we all know what happened in January. The Huskers won that national championship. But he is a man that kept his word. Him and Coach Sulich flew down to Pine Bluff, Arkansas, met with my grandma at Dillard's, met with my coach, met with me at the school, and it was a no-brainer. No one from Arkansas ever had this opportunity except for Eric Warfield, who was from Texarkana, Arkansas. But it's been a dream come true, and to be able to play on his other team, called Teammates Mentoring, best things in life. Right here in Nebraska.
Well, I think Teammates is an amazing organization. We have financially supported them for many years. I think we need more mentors out there, and that's why we asked you to come on the show, is to explain to people what the process is, but really just how easy it is to give back. You guys have made this, you've got a formula where, I volunteered at other organizations like Big Brothers in the past, Big Brothers, Big Sisters, et cetera. You guys have this down to once you've got trained and are assigned a mentee, literally an hour a week at the school,
yes.
So you make it so simple, convenient, and you have so many kids in need. I believe you told me there's over 500 waiting for mentors right now. Is that right?
Absolutely. We have at least 500 students that are on a waiting list in Lincoln, 500 that are on a waiting list here in Omaha Metro. So we're talking over 1,000 students. These are students that want a mentor. They want an additional caring adult that we call a teammate, simply just to hang out, listen, play a game, not always on their case telling them what to do, but ask them how they're doing.
Yeah, somebody just, hey, how you feeling? What's going on today? And just they need a sounding board that maybe isn't mom, dad, or their teacher, et cetera. Just a, it's nice to vent sometimes to a third party, so to speak. And when you're growing up, there's a lot to vent about, right?
Absolutely. Students say it all of the time, even my own kids. Students don't care how much you know until they know how much you care. Students, they need additional caring adults that they can trust, someone that they can just talk to. And that's what helps them to get to that touchdown. We want them to not just be successful in the classroom. I like to call it the game of life, but they have to be winners in the classroom through attendance, grades, behavior, so that they can be winners in life. And we've been doing this. We've served over 50,000 students over the last 34 years, but there's so much work that can be done. But we need more people to team up with teammates.
Well, so we've put together 2 opportunities for our listening audience to just come learn. You're not making any commitment, but if you would like to learn what it's like to be a mentor, we're going to have DeMoine and some of his staff from Teammates right here in our office in Omaha. That's going to be coming up on Friday, August 8th at 8:30 in the morning. We're going to have some coffee, and we're debating on donuts or where they're from. But anyway, we'll talk about where
Krispy Kreme is my choice, but
we'll see. But so we'll have some coffee and donuts for you. You'll be in and out in less than an hour total, where you're going to hear about what it's like to be a teammate. If you consider being a mentor and donating your time, there's over 1,000 kids waiting this fall. And then the following Friday, for those of you down in Lincoln, or if it's more convenient, we're going to have an event similar in Lincoln. We're location to be determined here, working on the logistics of that down in Lincoln. Our office won't be big enough to host everybody there, but we are going to get a location. So tell everybody a little bit about what they're going to learn here at this event. How long? What's the process if they come to this event and they say, you know what, I want to give back to the community? What do they got to do?
Absolutely. So people are going to learn our history, our story, our mission, our vision, our core values, our impact. They're going to learn what a mentor is and what a mentor is not. They're going to learn what a mentor is doing when they spend time with a mentee. They're going to learn that we serve all students. They're going to learn our greatest need is that 3rd through 5th grade. And we're going to walk them through, talk them through really the process. Going to teammates.org is the first step, and completing that first part of training. And then the second part will be done in person. All we're really asking is for the gift of time. Many people give back to their community with a gift. Maybe it's financial, or maybe there are things. But the gift of time, as Coach Osborne likes to say, is the greatest human resource a human can give to another human.
No, we've been blessed. Tom has given us some time a couple of times. Actually, he did the grand opening at our office in Lincoln several months back. But that's what I like, is just the character and the leadership of the people that he has mentored along his way. Not just to make you guys great football players, obviously, some success on the gridiron from the win-loss column, but he's turned, and I'm sure you have hundreds of stories. I've met several former Husker players. I go to church with one who's associate pastor. They just become incredible men. So that's what I think is so impressive about his legacy, is the quality of leadership that he's instilled in young men. Obviously got paid to win games, put W's on the board, and built the fan base. But you really see the legacy in the careers that you, your friends, and all these former players have had. And in fact, you and I got to chat and see several of your former players there at your golf tournament that we started sponsoring this year. That was fantastic to see so many of the players coming back just to show love, and even Coach Rule showed up to that one. Maybe we'll get him to show up at an event for us for the teammates thing here in the near future. But just it's fantastic to see the legacy that he's done. How many people are in the organization? How big is Teammates? You guys are in multiple states now, right?
We are. We're currently serving over 10,000 students. We serve 6 states, so 151 school districts in Nebraska, 8 in South Dakota, 23 in Iowa, 15 in Kansas, and 3 in Wyoming, 1 in Missouri, Rockport. We just started. And we have a team of 34. I believe that leaders don't create followers. Leaders create leaders. So going
John
back
Maxwell
to
quote right there.
Yes. Leaders don't create followers. Leaders create leaders. And that's a testament of everything that Coach is doing with myself, all of those players that you saw. we have learned the value, the importance of using your role to be a positive role model. We believe that that is the community's personal and social responsibility. We're not asking for experts. We're not asking for someone to be a tutor or to be a therapist. We're simply asking them to show up, give their time, and use their role to be a positive role model.
So there's really no financial commitment. Just their time is all they have to do. Show up, just be there, really. And you guys will train them exactly on what to be saying and, how to coach along, et cetera. So you make this incredibly easy. Do you have folks that are mentoring multiple kids? Is there many mentors that do multiple kids?
Let's start with our co-founder. He's 88 years old, and he's mentoring 2 kiddos. I just had a student who graduated. I'm getting ready to be rematched with a young student. And when our students graduate from high school, you can continue to mentor them as they pursue their post-secondary education. So mentors, yes, they can definitely mentor too. But the commitment is once a week at the school during a school day. So
I imagine you have some mentees becoming mentors as they mature in life, and 34 years of the organization existing. That's probably some pretty good stories along there.
Talk about the ripple effect. Our oldest daughter, my oldest daughter, who is getting ready to graduate, she was in the program since middle school. And then as a college student, she became a mentor.
Nice.
And she's still being mentored to this day. And so there's definitely a ripple effect. That is our hope, is when students graduate, they see the benefit of giving back to their community that they serve. Because the best things in life are not things. The best things in life are people. And it's our young people that we are rooting for. They need cheerleaders. They need fans. They need people that are saying, winners never quit, quitters never win. To give them that grit, that resiliency. That's just the football that's still in me. But I do believe that education, what they're trying to do for our students and what Teammates is doing, that's the teamwork that makes the dream work.
Man, that's awesome. So again, we're out of time for this segment. If you would like to come to one of these events, we're going to have it Friday, August 8th. Here in Omaha at our office. That's at 8:30 in the morning. You do need to register, 402-369-7777, or go to the retiresmartnow.com and click on the events tab to get registered. Or the following Friday the 15th in Lincoln, we'll get you that location. Or if you don't have time to get to either of those and want to find out more, just go to teammates.org to learn how you can make a difference in a child's life. DeMoine, thank you for stopping in this week.
Yes, sir. Thank you.
All right, Chip, what do we have next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, the first question is about what's called a blended retirement. I am going into the military and was told everyone is enrolled in the blended retirement system. Will I need financial advice, or is everything managed automatically in that system? David, maybe first tell us, what is the blended retirement system, and then what's your answer here?
Okay, so our old military system, you didn't contribute. Basically, you got a pension if you stayed in your full 20, basically equivalent of full 20 years of service, and you ended up with a 2.5% salary for each year of service, et cetera, depending on how you stayed. The system cut it to 2% now, so the new blended system, you only get a 2% vesting for each year for your pension. So your pension's going to be less than it would have been under the old. However, the Department of Defense contributes to the TSP on your behalf, 1%. And there's a match. I believe it's 1%, and I don't have it right in front of me. But you can get up to a 4% matching contribution if you contribute. So they're encouraging you to save, and then they will put money in. You also have the Roth available in those accounts. So you can put money in an account, pay the tax now, and those dollars for your 20-year military career plus whenever you want to touch them will be tax-free if you follow all the rules. So the new system can be really beneficial for those that are going to be prudent and diligent savers. But yes, bottom line, you should still seek out professional advice so you can understand the differences, the traditional side, the Roth side, what you're going to do. Most military professionals get out of the military in their 40s, their careers, plenty young enough to establish a complete second career and have a 20-year career in another field. I have several friends that have gone into teaching. It was a calling to them, but because they're blessed with a military pension, now the teacher salary, which I always talk about is not enough, in my opinion, they can afford to have a pretty nice lifestyle because they're getting the pension as well. But you need to be planning for your post-military career. If you're going to make a career out of this, how does this work? And yes, you should put some skin in the game and contribute to it and understand what you're also allowed to do outside of that plan, which you can fully contribute to a Roth IRA, et cetera. You can save on your own. So absolutely, I would still say that you would.
There's a variety of decisions you need to make.
Yeah. And so first and foremost, thank you for your service to our country. And we'd be happy to set up a complimentary phone call with one of our advisors just to get you started in the right direction.
Next question, David. Debt versus growth. I have about 4 years left until retirement, and I'd really like to have $1 million in my 401k when I finish working. I should be able to achieve that if I save aggressively, but I also have a lot of debt. Should I focus more on paying off the debt or piling up more money in my account?
Okay, so here's the quandary is, do you invest more, compound that money, get the growth on the dollars to see a number? And again, $1 million is a nice number the first time you see that number behind your name or in an account. Becoming a millionaire today is not quite what it was, 20 years ago, but it's still a significant milestone, and we want to say kudos that you get there. However, when it comes to retirement's about income, Chip. How much income will you need? When you stop earning that paycheck here in hypothetically 4 years out, what will you need take-home pay to pay your bills, including your debts? Will your savings at that time, whether it's the million or shortfall of that because you paid down debt, what's going to be more important? Well, we would need to plan that out. We need to know what the interest is on that debt, how much of that debt is. Is it realistically that you could get that debt down? What is that monthly payment? And here's a simple rule of thumb. If you were going to take a 4 or 5% distribution on your retirement, assuming you're in your 60s, that would be relatively safe number, just to assume. So if you got $1 million, let's just use 4%. There's the old 4% rule. That'd be 40 grand a year in withdrawals that math says you might be able to take safely. Again, we can argue if that's safe or not, but how much debt payment are you talking about you'd still have if you went for the $1 million versus paying the debt? Is it $1,000 a month? Well, that's $12,000 a year. That's over 25% of that income you're going to withdraw. So you might be better off paying it down. But again, we got to figure out how much debt, how much interest you're paying, and then we can work the numbers out. But this is a great question. And this is why you want to work with an advisor who you pay, right? Versus an advisor who gets paid to sell you a mutual fund or a variable annuity or something and only works commission because they're going to tell you to buy the investment, right?
Well, we use the term fiduciary, and that's what you're talking about,
yes.
right?
And so you could set up, again, perfect person for the report card to find out, because we're going to look at not only your assets, but your liabilities, and then help you align which one of those is more important. And we talk about on this show, I paid off a mortgage last year. I owed less than $100,000 on a house that's worth probably $700,000. At a 2.5% interest rate. I think it was 2.7, because it made my wife happy, not because it was a smart financial decision, at least in my opinion. But I had that money in a guaranteed account earning over 4.5%, but happy wife, happy life. So we can do the math, but then we also have to make the decision that's right for you.
All right. So the 4.5 was beating the 2.5 that you were paying in interest on the mortgage.
In my favor.
But there are other considerations. It emphasizes what we see so often. It's not a one-size-fits-all proposition. For one person, the answer might be yes to this question, pay down some more debt. For another, it might be no, right along with that mortgage at 2%,
Correct. And it depends. What's the payment? What's the cash flow that you have? Do you have other resources? There's a lot of factors into it.
Yeah. All right. Let's squeeze in one more question, David. This one is about cash deployment. My husband and I have $50,000 cash that we want to invest, but we keep hearing that a market correction is coming. Should we go ahead and invest the money or continue waiting for the right moment?
Look, if you're going to try and time the perfect moment, you're likely not going to call the ball, so to speak, right? So I would tell you that you should practice something called DCA, dollar cost averaging, on the accumulation of investing for retirement. This is one of the reasons most Americans are most successful through their workplace retirement plan, like the 401k or the 403b, because you're dollar cost averaging. They take a little bit of money out of your paycheck each week or each payroll period and invest that in the market at the time you put it in. So what happens is when the markets are a little higher, you buy less shares, but you're still buying. When the market's a little bit lower, you buy more shares of the same thing, but the price is down. Your account value might be down short term, but you're not buying for now, you're buying for, and you end up paying less per unit on average by using what's called dollar cost averaging versus lump sum putting it all to work at once. However, I want to put a word of caution. The exact opposite happens when you're starting to withdraw income. And this is why the math is so different. Dollar cost withdrawing can literally wreak havoc, and you can run out of money because of what's called sequence of returns. Again, so many great questions this week, and why it is important that you work with a competent financial professional to help give you these type of answers. So I would tell you, though, start investing, put some money to work. It's never going to be the perfect time. And then dollar cost average that in maybe over 6 months to a year-long period. And then if the market dips, you're buying things at a discount.
Up next, Berkshire Hathaway usually outperforms the market, but that has not been the case lately. We'll explore that next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David, here's a CNBC headline. Berkshire Hathaway continues to underperform after Buffett's exit news, now trailing the S&P 500. Now, is this something other than market rhythms and cycles? What do you see?
Well, this is the Buffett premium kind of coming out of the stock, right? So the stock is valued at what it is, but people have always been willing to pay a little bit more, a little bit higher multiple with Warren Buffett, with his track record, obviously, at the helm. Now that he's officially announced his retirement, you're seeing some investors maybe pull some capital away. And again, they're going to let Mr. Abel, who's taking over or will be at the end of this year, prove himself, so to speak.
So this is more of a psychological thing. This isn't that Buffett or Abel or anybody else at Berkshire Hathaway is making a string of bad decisions.
This is just what we call the Buffett premium coming out. So when someone has a proven track record, like a company is growing, we were talking about Nvidia earlier in the show, right? Yeah. And how it got it. Well, because they've seen just insane growth, people have been willing to pay a much higher price than they would have normally for even a tech company. It's the same thing here. People have always been willing to pay a little bit higher premium to follow Warren Buffett's advice because his track record has proved you would win in the end. And you're just seeing that Buffett premium come out of it a little bit. So, if you believe in the leadership that he's built up there and the management going forward, then it's telling you it's a great opportunity because, yes, since the day he announced it, Chip, and I don't have the exact numbers for me, the S&P has rallied double digits from that point, and Berkshire has dropped double digits. So it's over a 20% alpha there, that you're getting a discount to maybe where it would have been otherwise. So maybe it's a great time to buy it if you're a long-term shareholder and believe in that management team as you may have done in the past. I am full disclosure, a shareholder in Berkshire Hathaway, but we're not making any recommendations. I just want to tell you, but yeah, that's what happens when you see a change in leadership.
David, we've run across several top 10 lists of the states in this or that category. Omaha and Nebraska have fared well recently in a list showing quality of life, and that was part of a broader index of friendly for business. We were tied for 8th, a three-way tie for 8th in quality of life in Omaha, 15th for business friendliness. Now, here's another survey, this one by LinkedIn. LinkedIn Cities on the Rise 2025. The 25 fastest growing U.S. metros for jobs and new talent. Rounding out the top 10, Omaha.
Well, I this is what I kind of say to all those that have been yelling and screaming that, oh my gosh, we can't cut taxes, brain drain, we're not giving enough to society here to keep the young people here. Well, this is telling you the exact opposite is true. Omaha is a great city, as you said. It's 15th in business, or the state is 15th, in
business friendliness.
Now, we have a new mayor, and we've yet to have him in long enough to kind of judge. Yeah. But we'll see if that continues to help us positively attract talent, or does he scare people away? A couple of his announcements have scared a few people on some things. But again, this is another great ranking for both Nebraska and the city of Omaha.
Well, it was an intriguing list. Grand Rapids, Boise, Harrisburg in Pennsylvania, Albany, Milwaukee.
What do you have in common with all these, Chip, is they're not major cities. They're not the top 25 or 30 cities. You're going to the next tier down. And that's where I will tell you, trust me, when we decided to open the business here in Omaha, we did the research pretty deep, and that's what we're looking for. Is I don't want to be in a city with 5 million people, right? So I don't want to be in a Chicago, I don't want to be in New York City or a LA or even a Dallas or a Houston. They're just so big that the cost to operate in those cities is quite expensive. The commute is longer for the employees. They have higher expenses for auto insurance, things like that. So So these factors, Boise, these mid-level cities are flourishing, and we've seen that since COVID because people have been a little bit more mobile. They're gravitating to cities that have a better quality of life. I love the article.
Well, this caught my eye too. Top industries hiring, and the first one listed is financial services. We're hiring so many people, I can't keep track of all the new names.
Yeah, I know. We see names around here, and I'm done. My wife's like, saw somebody's name in one of our teams mentioned. She goes, "Who's that?" And I'm like, "Give me a minute."
Yeah.
I'll think of it.
All right. Now, at the other end of the spectrum, here's the CNBC headline. New York City braces for wealth flight with Mamdani's political rise. The reference, of course, is to Zoran Mamdani, who appears to be the favorite to win the next election for mayor of New York. He's pretty much an unabashed socialist, communist. I mean, we've been documenting this and following this for a couple of years now. There was already a flight out of New York to Florida and other places. Is this just going to accelerate into a stampede now?
Well, the great former Prime Minister of England, Margaret Thatcher, paraphrasing her quote, is, the problem with socialism and socialistic policy is sooner or later you run out of other people's money, right?
Yep.
And while it's a nice populist message for him to shout from the rooftops there to get elected, he's talking about he's going to open up city-owned grocery stores that have no profit motive. Well, what's the incentive for the manager to change the inventory out to make sure that the freshest product is on there? Profit motivates action, right? And incentives from that profit that you can compensate your employees motivate them to do certain actions for things to run efficiently. That's why Wegmans and Alberts, these Hy-Vee, Kroger, these grocery stores were able to grow because they were able to profit enough to pay for the talent they needed to expand. Every time you've had government get into an industry, the costs go up and the service goes down. Look at healthcare today. How disaster it has been since the ACA, the Affordable Care Act, has done anything but make it. We're premiums up over 360% since that act was passed, 15 years ago now, 16 years ago? And so, again,
it's hard to find a plan for less than 20 grand.
Kevin O'Leary of Shark Tank fame, right? Mr. Wonderful is a Canadian investor. He was just on CNBC this morning, or Fox, I don't remember which one, but he was talking about it. He reached out to Mamdani's campaign. He wanted to have a meeting with him because he's got a lot of money invested in New York City. And if the policy he's talking about, he's like, hey, I want to get a clear understanding. But he's like, yeah, the capital's going to go. The capital can pick up and leave, Chip, and the city's going to find out. But we'll find out. I think it's November 4th is their election, and we'll know pretty soon after that what's going on.
Well, even, Governor Kathy Hochul, who is not by any means a conservative. Left, but here's her comment in the story. I don't want to lose any more people to Palm Beach, meaning Florida. So even the Democratic governor is worried about what might be transpiring in New York City.
Well, people are going to get up and move when they need to. That's just it. You put policies in place that are prohibitive for business growth, and the businesses can get up and leave.
Well, now, did you just say people are going to get up and leave if they want to? Because here's a Fox Business headline. Billionaire In-N-Out heiress Lindsay Snyder and family leaving California for Tennessee. This is the iconic burger joint. I think In-N-Out even predates McDonald's. I think it goes back even further than McDonald's and was built and grew in California. It has spread to other states. But now Snyder and her family are going to leave California for Tennessee. We've seen this happening,
and
as I say, for years.
She did an interview, and then people were kind of attacking her on social media. So like, oh, she's a billionaire. What does she know? Well, just so you understand, she inherited the stock in 2006. And it was about a little over $400 million that she inherited at the time when her father passed away. It was started by her grandfather. Her grandparents started it. She inherited a trust that is not hers, but she controls the trust, which has the other majority shareholder of it, which was her grandmother's stock, and her grandmother passed. But she's grown the company from when she inherited.
She's working it.
Oh, she's worked in the kitchen, cuts fry. She started at the bottom and worked her way up.
She's not just a trust fund baby.
And she's grown the value of that company from $400 million in 2006 to $6.7 billion, I believe, when I looked it up today. And the problem is they want to overtax corporations. The minimum wage in California is over $20 now that they have to pay employees, and they're making it untenable to be able to expand and grow. And guess where she's moving? To Tennessee.
yeah.
What is Tennessee's income tax rate, Chip?
I think it's 0.
What's their corporate tax rate, Chip?
Is that also
That's
0?
correct.
That
0.
I didn't know.
So Tennessee is
Wow.
setting up to say, hey, we welcome
Yes.
business move. So capital, hey, watch New York City businesses get up and move. We've already seen some moved in Nashville. We've seen this out of Chicago. Again, the money will flow where it's incentivized to go find a home.
Well, now, In-N-Out will still be a major presence in California.
Yeah, they're not shutting down their restaurants. They're moving the headquarters.
And they're keeping one of their corporate offices there. I think Baldwin Park is like the ancestral legacy beginning home of In-N-Out. But Snyder and the true corporate headquarters are going to move to Tennessee. And she said it's just getting too hard. You know, interesting, David, she said it's getting too hard to raise a family and do business in California. So there are other forces at work that she finds making it difficult to raise a family as well. I don't know that we have the time to get into all that, but also she is, as you pointed out, she's working the business. This is a person trying to run and grow a business saying, you're making it too hostile. I'm going to find an environment that's more friendly.
Well, no, and here's the thing. California, if they kept the corporate income in there, they would have benefited immensely. But because they've chosen to be this harsh with corporate businesses and call them evil, yada, yada, she's going to move. Now, they'll get paid on the business that happens in California, but that's it. When she moves to Tennessee and it starts expanding in and out throughout the Southeast, which we'll see them all over. Now, we don't have In-N-Out here locally, but when we travel, my son loves to get an In-N-Out burger. When we go to certain places, I go down to Dallas for conferences. I do run by the In-N-Out, So they're going to expand. They're going to benefit. And now who's going to benefit? Well, other communities will benefit from that business expansion. Job creation will come elsewhere, et cetera. So California ends up losing. So that's, hey, watch out, New York City. You might be asking for this type of things to happen with businesses in your market today.
I'm grinning because 3 of my 7 children, they began their lives in the Bay Area and grew up eating In-N-Out burger. And when we adopted them, they came into our family. We went back to the West Coast to visit some of their family and friends there. And before anything else, even before the people, In-N-Out. They wanted to get to an In-N-Out, the animal style.
When I love how they are subtle. It was a Christian family, right? So very subtle things on the bottom of the cup. John 3:16 is just imprinted on the very bottom of your cup.
That.
Oh yeah, if you look at it's on the bottom of your cup. If you don't know, there's scripture on their fries. So they do it in a subtle way. It's not plastered everywhere.
Yeah. Okay.
It's just the faith of the founders. So I thought that was pretty cool.
Well, that'll do it for this week, folks. Please visit our website, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer. No charge, no obligation for our events, but you do need to register. You can do it online or by calling 402-369-7777. David, bring us home.
Have a blessed and prosperous week. We'll talk to you next time.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week. Neither Tom Osborne, DeMoine Adams, nor teammates are clients of Retire Smart and were compensated for this sponsorship endorsement as such term is defined under SEC Rule 206, subsection 4-1. For further information about this sponsorship and the compensation details, visit retiresmartnow.com and click on the Sponsorships tab.